Good morning, everyone. Today is August 3rd. I am Joanne Koontz. I'm here with my partner, Marina Parkin. We are talking to you today about 1031 exchanges. As you know, our Florida real estate market is hot. Lots of people having lots of good tax planning problems because they're selling their properties for so much more than they bought them for. So we love those planning opportunities. And we get lots of calls about 1031 exchanges with a lot of information, more importantly, a lot of incorrect information. And so we wanted to kind of set the record straight for you today. As always, you can ask us questions at the bottom. There's a Q&A box. Please use that. And our webinars are always recorded, so you can run this back if it was so interesting and compelling that you feel the need to, or you can share it with a friend. And they'll be posted on our YouTube channel, on our Facebook page, and on our firm websites, KoontzAssociates.com and KoontzParkin.com. So without further ado, let's jump in. So the 1031 exchange, let's just start right there. What is it? So common misconception is people think this is a big eraser that gets rid of tax. False. This is a pause button on the date that the tax is due. So you're still going to calculate the same differences, the sale price of the property, less realtor commissions and any other deductible expenses, less your basis in the property, which is going to be your purchase price plus any improvements that you made during the time that you own the property. We can jump more into what goes into each category in a little bit, but from a high level perspective, that's really what we're talking about. That difference is the gain, and that gain turns into capital gains tax, and that capital gains tax is what we are looking to potentially delay. The 1031 allows you to, instead of writing a check for those taxes, to then reinvest that money into the next property that you purchase. So let's kind of start with what are the fundamental basics? What are the ground rules? Now, firstly, you cannot do this on a property that is your residence. You can't have it for your own personal use. It's got to be for investment. That means not only rental properties, investment properties, commercial, residential, doesn't really matter. It just can't be your North Carolina, you know, winter or summer home that you, you know, lease out in the wintertime. So it's either personal use or it's business use, and you got to stick with that. So again, more rules around that Marina will clean up in a little bit more detail in just a few minutes. But like any other ruling that comes from IRS, and the 1031 is literally from the code section 1031. So it's laden with IRS rules, many of which are worded nearly impossibly to decipher. So no surprise that there are a lot of misconceptions and a lot of inaccurate information. We field calls on a weekly, daily basis with people who say, hey, I spoke to a guy last week. I closed on my property in May, and now I'm ready to do a 1031. No, you're not. And here's why. So as with lots of tax planning tools, timing is critical. There's many timing deadlines that are associated with 1031s, and flexibility is not the name of the game. So in this market where it can be tough to get under contract, let alone get to closing, it's going to be difficult as well, more challenging now than in other times to get to the closing table within the timeframes. So that being said, what are the timeframes? There's two different types of 1031 exchange. The majority of our conversation today is going to be dealing with the forward exchange, the traditional 1031, where you are selling what they call your relinquished property, the property you're giving up. We are replacing it with a property that is not going to be a primary residence for you or a secondary residence for you, but that is going to replace that property. When we do that, we have timeframes to stick with, we have people to use. Qualified intermediary, QI, is going to be one of those folks that we need to stick with. Now, the qualified intermediary is a person who gets hired to serve in this transaction, and they hold all the money. That is not flexible, money cannot go to you as the owner, the seller. Money cannot go to me as the closing agent. Has to sit with the QI. So what happens is you are planning to sell your replacement property, your relinquished property. You list it for sale, you get a contract, you go to closing. That sale proceeds are then distributed to the qualified intermediary to be held until you purchase your replacement property. Qualified intermediary will then send the money to the closing agent on the replacement property, and at that point you will complete your 1031. Some other rules that we need to be mindful of is from the day you close on the relinquished property, this property that you're first selling, you have 45 days to identify your replacement property, and you have 180 days from that date to close on it. Mm-hmm. Not flexible, no extensions, no second extension, no. Can't do new construction. If the new construction's not ready, then your whole 1031 blows up. We want to be very cognizant of these timeframes. What I was alluding to earlier with the difficulty to meet these requirements is properties are flying off the market as quickly as they're listed. So it's very difficult to make sure that whatever you place on your identification list is something that you actually close on. Because you have, at this point in Florida, about 15 minutes to make up your mind when you're trying to buy something else. So it's making the timing tougher, not impossible, but definitely more difficult to comply with those rules. If you fall outside of any of the required timeframes, what's going to happen is you're going to end up paying tax on the full amount. Your 1031 will be terminated. So if you don't want to work hard and spend money to put something into place and then only to have it not be satisfied. So
Joanne, before we even kind of get into the 45 and 180 days, let's talk a little bit more about the timing of, I'm about to do this. How early or how late do I have to get into this 1031 transaction? So I'm closing next week. Oh my God, I just heard a 1031 from my neighbor next door. Can I still do it? How early and how much prep time does it need to happen? I know, like you said, we have 45 days to even identify the property, but if I know I have to park my money somewhere else, at which point is it too late?
Mm-hmm. At which point is it too late is after closing has occurred. That's really the only hard and fast, it's too late. If you've already closed, you are not getting involved in a 1031. So ideally, you would get with your qualified intermediary, get them hired, get them on board, and start understanding that identification process. There is quite a bit to that beyond the scope of what we're going to cover today in terms of which rule you're going to follow, how many properties you're going to identify. So there's a certain number of properties or a percentage of your price that you're going to have to meet, and that the QI will work through with you. So we've got to have them on board with you having an understanding of what is going on in order to do this, to determine like what kind of gain are we even deferring? Is this even worth it? I would say the average QI fee for a forward exchange is going to be between $1,000 and $2,000. So you don't want to spend $2,000 to delay 10. That doesn't make sense. But you do need to understand that there, when this is going to be worth it or not. And we'll talk about that.
Is it easy enough to get a QI, to get in a kind of an appointment with them or a call with
very
them?
Easy, very.
Okay. Well, one of the things too that people always say to me is, well, I haven't touched my money. The money went sitting in my account. I haven't taken it out. It's sitting in my, let's say, LLC or business account. I haven't taken the money out. So does that not mean that I can still do it? And the answer to that is no, because even though you personally haven't touched the money and haven't put it in your personal account, you've already received it. The transaction has already occurred. And unless that money really does go into the QI's holding account, the escrow account that they set up for you, it just doesn't work. And
absolutely. Yeah. And to that point, the qualified intermediary actually signs the closing statement. So they've got to not only hold the money, but participate in the transaction. So they don't agree, they don't sign the contract, they don't approve the terms or anything like that, but they do acknowledge there's a qualified intermediary signature block on the closing statement. So that is, again, back to complying with IRS rules. We've got to have that done.
And I cannot reiterate enough that you cannot have your real estate agent, you cannot have your attorney, you cannot have your CPA, you cannot have your broker, you can't have your friend who does this for hobby. You cannot have any of these people as a QI. It has to be a qualified intermediary who's specifically certified to be doing these things. This is why at any given transaction, people say, well, I already have an attorney. That's fantastic, but your attorney is not going to serve as a QI. So you need to have both parties involved. And as soon as you feel like you may want to consider this and you talk to your attorney who can say, hey, you know what, it's a good idea, or you talk to your CPA who will say it's a good idea, and we'll talk about the numbers in a little bit, you can have your attorney give you a reference to who the qualified intermediary is, but you can't wait till the closing table and say, oh, by the way, as you're signing your documents away, I am doing a 1031.
And from a practical standpoint, to answer the question you asked earlier, is when is it too late? You got to have at least a week before closing, because you got to think that the, as the seller, if there are deeds to be signed or anything that might change with this process, that we've got a heads up as the closing agent. A week is the dead latest from a practical standpoint that I would be letting somebody know. Frequently, what happens is they come in, they're under contract. They come to me for the closing, and then we start talking, and then they say, hey, what do you know about 1031? Should I look at it? And that's when I do this education, get them to the QI, etc. It's not imperative, but it is practically how it goes. Some people come in shooting right out of the gate, like, I know I want to do this. I already have a QI. I've already done 3 others. But, most of the people, this market is, of course, not the usual either. So people who otherwise weren't expecting to have such a huge gain are finding themselves like, hey, I've had this condo, I've been renting it, I was happy to keep renting it, but now my friend, sister, cousin, coworker, hairstylist, whoever is a realtor who put this bug in my head about how much I could sell it for. So now I'm thinking about selling it, and how do I go about protecting myself from tax.
So will the QI work with them, Joanne, about what it means really to identify the property? So exactly. What properties are good and what properties are not? They will help them. I mean, that's really what you're paying for there, or really what is their job?
So the QI's job is just to hold the money and to be completely independent from the transaction. You will see that there are lots of closing agents who also serve as the QI. They do have a separate business. They are trying to technically stay within the letter of the law, but the IRS rules are really, the spirit of it is that it's a separate person away from the transaction, not the closing agent. So that QI's job is to keep the money safe in this independent account away from the transaction, and to make sure that you are following the rules with the 45-day identification and the 180 days of closing. Now, just to clarify, the 45-day clock starts ticking on the date that you close on the sale of your relinquished property, not the day you go under contract. So if you're under contract for 45 days, I'm going to sell my property to you, and then from the day I close with you, my 45-day clock begins to identify my next property. That same clock is beginning on the 180 days to get to closing. So it's not 45 days to identify and then another 180 days to close. You have 180 days total. So we need to be cognizant of that. All the QIs charge differently, but I would say an average range of expense, like I said, is about $1,000 to $2,000. We use Old Republic typically, and I think they're around $1,500. So there are some local folks, if you prefer something local. I like to use Old Republic because I have a lot of clients who are selling something out of state and coming into Florida, and then you can use the same qualified intermediary across state lines. If it's someone local, they might only be licensed in Florida and not able to help you in Colorado or Pennsylvania or Connecticut or wherever you're coming from.
You can email us and we'll give you the contact for the Old Republic folks that we use, that we refer people to. I see a couple of questions popping up there about that, so I just put my email on there.
Perfect. Yeah, that's easy to dump that off on you, but they'll keep you in the bounds. The issue is going to be if you put 3 replacement properties on your 45-day list and all 3 of them sell to somebody else. Now you're out of you're out of replacement properties. So you have to really work with them closely to stay within those guidelines.
So I think next, Joanne, let's talk a little bit about the whole like-kind part of it. What is like-kind to each other and what is not like-kind to each other?
So like-kind makes almost as much sense as principal residence rules. So in the IRS land, the principal residence isn't even necessarily somewhere you live right now. Same thing with like kind. You may scratch your head and go, that doesn't look too terribly like to me. So you might have a commercial warehouse and that is like kind to a beachfront rental. So as long as it's investment property or trade or business rental property, you could be holding a vacant lot for appreciation in Northport and sell that and buy a condo on Siesta Key. You're still going to meet those like-kind rules. So
let's talk a little bit about the questions that we always get now because of so much construction. How do we go around the construction? So we're buying a lot. So if that lot, the lot will be the like-kind, right? The lot is good. The empty lot.
The empty lot's fine, but usually that's not going to be enough value for you to be happy with the 1031 exchange. So let's say that what I'm selling to buy this lot to build on, what I'm selling maybe is $500,000. I've got to invest my sale proceeds. And if the lot is only $300,000, I'm not going to have, I'm going to pay tax on the $200,000 difference, right? So it doesn't matter if you buy the lot and then build. If you are buying from like a production builder where you buy the lot as a part of your home building package, then that's not going to count at all. You would have to separately close on the lot, take title to it, and then commence construction for the lot to even count. And I'm not saying, I mean, it's Florida. You could if you go buy a lot on Longboat Key, if you could find one, you'd eat up, plenty of money in a hurry. But if you're off in investment land down in Northport or Port Charlotte, you're not going to hit those numbers that you need to. So to the extent that you do not want to reinvest all the money, maybe you want to get a little, maybe you're heavy in investing in real estate and you want to diversify, you could sell and only reinvest half, and then you pay tax on half of the gain. So that concept, if you're reading about this or anything, is called boot. Anytime that you take cash out of the transaction, and you would pay tax on that amount of money.
And I can talk about that later as well, Joanne, because in fact, we just had a situation last week that I worked through, and we were all crazy because we couldn't figure out. And of course, it turned out that they took too much boot, as you say, out, and there was really nothing left to defer. Yeah. So
if you take
the intermediary, yes,
you get booted out of your transaction.
Yeah, you get, that's right. You get booted out of the transaction. That's exactly that's probably why they even assigned that term to it. But that's exactly it. And we can talk a little bit about how that can kind of go sideways. Yeah. One thing that I also wanted to ask about the whole like kind part of it is, what if there's tangible property that is thrown in there? So you've got your residential rental and you're selling it, everything. You've got your furniture and fixtures and appliances, and now you're buying a warehouse. What happens to the value that's assigned to that tangible stuff?
Well, that becomes another battle. Because, what number are we picking and how reasonable is it, and what did you reflect in it on your tax return previously? So if you had established a basis in the tangible property of $50,000 and now you're trying to sell it and you're trying to say it's $5,000, is that reasonable? Well, I don't know, because how long did you have it, and how old was the stuff, and where was it from? It's kind of the similar argument to what we have on tax returns when people make a donation to a nonprofit of tangible goods. Like, well, did you donate Gucci or Wrangler? That's going to really gauge what the value is. So we need to be reasonable there. That's obviously going to be a hot button for audit. But to the extent that we do have the personal property, we're gonna pay on that too. Sorry.
Can I get a property in Canada?
No. I know. Quit trying to leave. You're not going back home. You also cannot get a property in Italy. Sorry.
Can I get a rental in Italy?
No.
Not change your mind?
No. No. I would love it if anyone was going to make the argument for that, it would be me. But no, this all has to be U.S. property, unfortunately. And U.S. real property, not anything movable. So not your farm tractors or anything like that.
So staying on that like kind part, and how you made very specific note about you can't buy it as a principal residence or anything like that. Let's talk a little bit about that. There's definitely been a lot of talk about, well, what if I exchange the property and I get another investment property, say a rental, and then I keep it as a rental for a certain amount of time, and then I convert it to principal residence, would the conversion at that time trigger the gain? So this is where it gets a little bit gray if you want to chat on that subject for a minute.
So whenever we do things that get gray, I like to get people back in the mind frame of like, when you hear your kids tell a story and you're like, that doesn't even sound believable. So it depends, really. There's not you're not going to be able to research and find like the rule. There's not a certain amount of time that makes this permissible. What there is a time where it becomes more reasonable. So, you know, if you bought it as a rental and you converted it to your primary residence, I would be looking at how that unfolded and when. So if I bought it as a rental and I rented it for 6 months and then it turned into my primary residence, that seems a lot less believable that your intention in the spirit of your transaction was really as a rental. If it was a couple of years, yeah, maybe I was a few years from retirement and now I've retired and I'm moving in. Those components all seem to work together nicely. Also, when we see this a lot when people are moving from another state, when they're coming from out west or up north, and it's reasonable to say that something would start as your rental property in Florida, and then you would ultimately change jobs or retire and move here. If it's across town, that is a little bit trickier. Not impossible, but again, I might want to see more time frame between trying to convert that into a primary residence. We also see it when people trying to get out of Florida up to North Carolina or something like that. Where it can be really helpful if done properly is if you're leaving a state with a state income tax on the capital gain of the sale of that rental property, and instead you 1031 into Florida, and then it becomes your primary residence. Once it's your primary residence for 2 out of the last 5 years, you then are subject to the 121 gain exclusion, where you can exclude up to $250,000 or $500,000 of gain, depending on whether you're single or married filing jointly. If that happens and you can complete that conversion, you may be able to escape the capital gains tax in the state that you left on the initial relinquishment. Now, keep in mind, with 1031s, these go as long as you are invested. So you could sell your house in Colorado that you rented, buy a beach rental in Florida, sell the beach rental and buy a cabin in North Carolina, sell the North Carolina and go back to Colorado, and all have been 1031s rolled in properly, and you could not have paid tax on any of those. But when you sell the final property and you don't replace it with something else, every transaction point had its own capital gain. Then you're going to pay tax on the accumulation of those at whatever the tax rate is at the time that you stop 1031ing. So you could be in this forever, or you could be in this for a couple of years. It's up to you.
Yeah, this is definitely something where it's not a magic eraser. The only really thing that is kind of a magic eraser is the state tax. This is where we've seen a big strategy. So even if we back up to the point that you made about moving from Colorado to Florida and then converting, even if you don't convert to personal residence, let's say you're getting an investment. So you're getting rid of something in New York, and then you're buying a couple of properties here. The New York tax that you've deferred by doing the 1031, once you're out of New York and you're a non-resident and you no longer have anything in New York that you even need to file for, you become a non-resident of New York. When you hold these properties in Florida now, you hold them, you can get rid of them, you can keep them, you do whatever you want. Once you actually trigger the transaction where you start to sell the exchange property, you're never really paying any New York tax. So nothing really triggers in New York. So this is where a huge opportunity to come to Florida to do these 1031 exchanges is basically being able to erase the state income tax. So I think that that's definitely a strategy to use there. So
Absolutely.
Yeah. So I guess this is probably a good time to talk a little bit about the pros and cons in terms of the actual tax deferral and what to do. What do you think, Joanne? Are you ready for me to?
Yeah, but before you do that, let me say one thing too, and keep in mind, transaction to transaction, the other rule we haven't touched on yet is that the taxpayer must remain the same through the entire transaction. So you can't be partners with your ski buddy in Colorado and then buy something in Florida by yourself. and then go back to the partner. Like the taxpayer has to be the same through these transactions. So be cognizant of that, particularly as we have LLCs and things like that.
If you are a single member LLC, so if you form an LLC to hold your new property, that's fine too, because the ultimate ownership, it's still you 100%. So we find that a lot. In fact, we had a situation where a person sold one huge property in the state that they were moving from, and got a couple of different properties here because of the value. And each property here was put in its own LLC, but ultimately the taxpayer was the owner of those LLCs, and they were just disregarded essentially for tax. They were just legal protection vehicles. So I think
that is the taxpayer is the same, absolutely. But we have to be cautious when it's not.
There's other people involved for sure. Even if there's family, Joanne, right? So even if you have a, let's say, a husband who owned the property and now he's married and now there's a wife, I think that can also get a little tricky, right?
Oh, absolutely, absolutely. That all needs to be planned out, and that the QI is not going to do with you. The QI is not going to do any tax planning. They don't know what you're going to pay. They're here to keep you in the square box that is the transaction. So you really need a closing agent, a QI, and an accountant to make sure that your three-pronged stool is sitting securely.
So there's a couple of things that I wanted to mention on the tax side, and Joanne is exactly right. Nobody really quite understands the tax impact of how this works. And you usually hear 1031, it means I defer the entire amount of gain. The idea here is that the value, it's not just the property that has to be like kind, it's the value has to be equivalent. So if you're giving up a property that's $1 million, you better get something in return, another like kind property with the value of $1 million. It could be 4 different properties at $250 each or whatever the case is, but you've got to have the properties. So literally the idea here is that you're not getting anything out of transaction. Now, here's where it gets a little interesting. Let's say I need some cash and I got $1 million property and I don't want to trigger the whole entire gain that I have because I have a huge gain, but I want to get some cash because I'm cash strapped. So I say, okay, well, if I can identify, let's say 3 properties worth $800,000 and then I can pull $200,000 cash out, is that okay? And the answer is yes. You just need to be prepared to recognize the gain on that amount that you pull out of the transaction. And it's not just the cash, like Joanne said, it's this concept of boot. And what is boot really? It's if you had a loan, for example, on the property that you are selling, and you got enough cash out to pay the loan, even though you didn't really see the money, but the loan got paid on the transaction, that is considered boot, meaning it was a benefit. It's as if you took cash out, turned around and paid the bank. The concept is the same. So now that becomes the benefit to you. So now you got to pull that out of the recognition of the gain and then say, okay, I'm now triggering some gain and I'm only deferring the rest. Where it got really, really funky in a couple of situations, and one I can speak freshly about because it just happened last week, is when we figured out the gain, what they actually triggered in terms of the benefit cash out and the repayment of the existing mortgage was actually bigger than the gain that they were trying to defer. So there was really nothing to defer. Because in our situation, we calculated that our gain was going to be $500,000, and then they actually took out about $700,000 out between the cash and the boot. So because they took out more than the actual gain, none of the gain had an opportunity to be deferred. In this situation, if you took out, let's say, $200,000 and your gain was $500,000, you could defer still $300,000 of gain. But in the situation where you're taking out a lot more out of the transaction than you have the gain to defer, there's really nothing to defer, and it just becomes a regular selling of the property and buying something else. So it was a little bit of a surprise to these folks. And they knew that they were not trading equal values, but they didn't realize how different it's going to be and what they were really getting out. And this is where writing that calculation ahead of time really, really makes a big difference. Again, the closing agent didn't know. I mean, they just did the closing, and the QI, of course, they had no way to even figure out the gain because the QI didn't have the information on the basis, and they don't even know what goes into the basis. So,
well,
really,
and they're specifically going to disclaim giving you any tax advice. They don't want any part of that. That's not $1,500 worth of fee. They're not liable for it. They're not necessarily CPAs. So they're, even if they know, they're not going to tell you.
Yes. That's exactly right. So here's how I like to think about it. This is what, when my clients come and they all hear the 1031 exchange, and this is great because I'm about to get rid of my property and make all this money. Here's where we start. Let's start steps at a time. So the first step that I like to tell my clients is, let's figure out what your gain is on the sale of this property. Forget about the 1031. Let's calculate the gain. Now, the gain, as Joanne said, is the difference between your proceeds on the transaction less the basis of the property. So it's the cost of the property that you spend buying it, including all of the improvements that you've done over the years, less any depreciation that you may have taken, so you reduce the cost basis by that. And then you can reduce all of that gain also by the closing costs. So you've got your commissions, you've got your, your real estate commission, your dock stamps, whatever it is that's on your side of the equation. So anything that's out of pocket on the sale, that goes to reduce the calculation of the gain. Sometimes when you get down to that calculation, it's not as bad as you think, because all you see is, I'm getting $1 million in my bank account from the sale. Yes, but you had bought your property for $400,000. You put another $200,000 over time to improve it. Now your basis is $600,000. Now you spend another, $150,000 in closing costs on both sides. So now you're at $750,000. So now your gain is not as dramatic as we think. So that's the first step, is to calculate the gain. The second step is to figure out what is your tax impact on this gain. And this is where looking at the tax rates and looking at your overall taxable income in the year is going to be very important. Because if you don't have much other income and all you've got is this capital gain, then the rate that you're paying on this capital gain may be very, very low. Generally speaking, the capital gain rates are still taxed at a preferred rate. So the gain is taxed either at 0, depending on the level of the gain, 15% or 20%. Most of the time, for people that think they have a big gain and trying to defer it, they're not in the 0% range, but it's either 15 or 20. 20% is the highest. Now, everybody's scared now because the rates are going up and the capital gain rate is going to disappear. So that's the kind of stuff we talk about with our clients, and we say, you know what? Yes, the 20% tax rate is going to disappear. We don't know when. It is hopefully not as early as the year that we're in right now, but at some point it will. So when you think about your gain not being so dramatic, the taxes being the lowest that it'll probably ever be on the capital gain transactions, why not consider actually just doing a regular sale, paying the tax, getting your cash, and moving on with your life? Then you don't have to worry about the exchange. You don't have to worry about this new property and fitting into all of these specific timelines. So it's doing the gain, and it's also calculating the tax. A lot of times you're able to also plan the transaction, to plan your other income to maybe not trigger in the same year as the year of the gain. So if there's any, that's where I think the tax planning on the timing comes in and say, hey, I've got other stock that I can sell. Maybe I'm going to hold off and do the real estate transaction in 1 year, do the stock in another year. I can kind of spread the tax impact of my gain and maybe be able to shove that gain into a 15% bracket. Now you're only paying 15% on the gain. So I think that you got to do those calculations first before you get QI crazy and call everybody you know and start driving around identifying the properties with your realtor.
And to be honest with you, that part needs to be long before a week before closing with me.
Exactly.
So.
Exactly. That's absolutely right. The other thing that I want to mention, again, when we calculate the gain, is you holding a mortgage on that property has nothing to do with the actual calculation of the gain. And this is exactly where people fall into the trap to say, well, I'm not going to be able to cash too much out because I still owe a lot on it. That's great, but your mortgage is not what goes into figuring out the calculation of the gain. It's the original basis of the property. So if you bought your property for $500,000 and then you had mortgage, and over time you paid down the mortgage and now your mortgage is $350,000, you're not using the $350,000 number to calculate your gain. You're using your original cost basis of $500,000 plus, like I said, improvements, plus closing costs, etc., etc. So forget about the mortgage. You really want to calculate the gain based on that cost basis, and not even worry about what is going to come out to pay that mortgage. So the gain is definitely extremely important to calculate. And I cannot tell you, Joanne, how many times we go through this calculation and people say, you know what, you're right. It's my tax is 20 grand. I'm like, for 20 grand, I don't want you to pay $2,000 to the intermediary and be stressed out about,
and worse, buy something you don't want or need or isn't a great fit because you're trying to meet these deadlines. If it's something that works anyways. I had a lady a couple of years ago who was trying to spend the rest of the money, and she bought like 3 rackaminium, like boat condos, like just because they were low enough dollar that she could shove them in. And it's like, well, did you really want those? Or is that just like what fit the Tetris puzzle? Because that's, you don't want to be saddled with something that's not a wise investment. So this is not something that should be done with, staring down the barrel of the gun. This should be like, yes, I was dying to get into the rackaminium and this is my opportunity to do so. And, good, bad, or otherwise, I'm not making any comments about that. I'm just saying, like, he looked at this and went, oh, those are little price points compared to houses, and I'll shove them in. Does that fit, or is that just a way to spend money? Because it's expensive to buy and sell with doc stamps and commissions and things like that. So you've got to factor that in as well. It's not just free money.
Well, and it really has to go, this whole transaction does have to go with your kind of big plan, because if yes, today you may want to defer the transaction, but in 2 years, you may want to start simplifying your life and getting out of real estate and start divesting. So maybe you start earlier because you're thinking about, again, paying low tax. And the other thing with the uncertainty of the tax rate, this is exactly the type of stuff that we talk about and say, you know what, when you defer this gain, and ultimately you have to recognize it when you dispose of that final property, your exchange price, let's say it's 3 exchanges from now, let's say it's the next exchange, whatever the case is, you're paying tax at the rate in effect in the year of your final sale. You don't get to go back and say, oh, because I deferred in 2020, I'm going to use 2020 capital gain rates to pay the tax. No. If the rates of that time, and let's say you're doing this 5 years from now, the capital gain rates are gone, and now you're paying tax at ordinary rates of 40%, that's what you're doing. You're going to pay tax on that deferred gain at 40%, while this year, you're getting your low rate. So I think I tell that to my clients as well, because we don't know what the tax rates are going to be, but they're going up. It's just a matter of time. And so today you're certain that you're going to pay this much. And that's the kind of stuff that that is also very important to talk about before you kind of jump into the decision to make that. So we talk about the rates. There's other opportunities to defer your tax a little bit. If you're so worried about the tax, you can do an installment sale, for example, where you become the mortgage holder and you can hold, let's say, a 5-year mortgage, and then you recognize your proceeds over time. So you're able to defer the gain a little bit, maybe spread it out over the next few years, but then you're not really stuck with like Joanne said, the exchange property that you don't even want to have and you don't like. And I think those are the kind, you just have to have an open mind and really go through the numbers to figure out if this is something that's even worthwhile doing.
It's really important to find the right thing too, because nobody wants to talk about this old PTSD, like twitching battle wound, but lots of developers got stuck with huge tax bills when the market crashed in 2007. And they had tons of gains that they had drug with them through 2004 and 5. And then they were like, I'm out of this game. And now it's 2007. Everything is gone. You've either lost it in foreclosure or sold it for a loss. And your old tax bills still due, because now you're not 1031ing. So this is definitely musical chairs, and the music will stop at some point, and you need to be prepared to have that money to pay those taxes, because we had a big wave of those calls that were like, okay, well, now I owe $1 million in tax, but I don't have any money. And I'm not suggesting that's coming again by any stretch. I'm not trying to fearmonger here. I'm just saying from a practical standpoint, that's a consideration to keep in mind.
Absolutely. I did want to bring up one concept that's become super, super popular lately, and that's the opportunity zone properties. So when we talk about deferring and getting into another property, if the property that you're getting into is considered to be in an opportunity zone, then if you hold it long enough and there's a specific time frame, you actually don't get to pay, you get to permanently erase the tax. That's really the only situation where you can't get rid of the tax once you get rid of that opportunity zone property on the ultimate sale. Now, that's the tax benefit. The risk, of course, is you're getting into the reason why it's an opportunity zone is it's an opportunity. It's not it's not a guarantee. It's very early stages of development. It's probably in the area that is not ideal. So you're a betting man, right? And you're betting on the fact that at some point this opportunity zone will have the value that ultimately down the road, when you're ready to sell it, you are going to actually keep growing the gain that you've deferred. And when you get rid of it, you get to walk away with tax free from that transaction. So that's definitely a plus. And there's a lot of let's say if you talk to a realtor or a commercial realtor particularly, they can tell you, oh yeah, this place is zoned, this opportunity zone, and sometimes you drive by the city and you see, oh, this whole corner is zoned as an opportunity zone. It's a risk you're taking for sure. Also, what's become really, really popular is, and we work with our financial advisors on this, it's these funds. So it's kind of like a REIT that has a bunch of different opportunity zone properties from all over US. And so when you're getting out of the property that you have, you kind of get into this property fund. So you're, I think, diversifying your risk a little bit, and that you're not getting into this corner of 4th and 10th. You are actually getting into a hodgepodge of different properties from Utah and from all different states. And then you have these funds. So then when you ultimately do dispose of them, you get to permanently remove your tax. But I think it's all has to do with your risk tolerance as well. A lot of people say, this is a long-term game, and these opportunity zones, who knows what's going to happen 10 years from now. It may be beautifully developed and there's a huge gain in that area, or it may still be sitting and doing nothing, and then I've really done nothing except push the time frame, and now I really need my cash and I haven't held it long enough to defer the gain. So that's also not for everybody, but I think it's worthwhile talking about if you have a nice tolerance for risk, and like I said, you've got a great financial advisor that can help you and walk you through these funds and talk about exactly how that works. But I got a few of our clients actually have done that, so I'll be interested to see how it develops in their taxable future.
Stay tuned.
Stay tuned. Exactly.
We do have one question. Can you please just kind of reiterate what determines which capital gain tax percentage you're going to pay? What's going to apply to this particular gain?
So what you're looking at there is you're looking at your overall taxable income. And if your overall taxable income is anywhere between, well, you know what, let me not lie, and I will give you exact numbers instead of just guessing. In fact, we just looked at it for one of my clients. So let's talk about just the common, which is the married filing joint tax return. So if you're looking at your overall taxable income being between 0 and 80,000, right? So your overall taxable income, if any of that taxable income is capital gain, that capital gain is taxed at 0. Right? Now you're getting into the next section, which is between 80,000 and $500,000. So if your overall, now that includes everything, your wages, your IRA distributions, your brokerage account investments, capital gains on your stock, everything. You put everything in the pot, you've got your income, and that income is $500,000, between 80 and $500,000. Then any part of the capital gain that's sitting inside that bunch of income is taxed at 15%. Okay. Now, if you're going to your total tax of $500,000 and up, any capital gain that's sitting there then is going to be taxed at 20%. So it can never go beyond 20%, but it's definitely, you're looking at your total income being under or over $500,000. Does that make sense? And that's for married filing joint. If for a single filer, it's half of that, so it's $250.
Okay, thank you.
Okay. Mm-hmm.
Any other
tricky concept, because people try to say, well, you know, but my all my other income, but then my gain is going to be less than $500,000. It doesn't matter. You got to look at your total income to first figure out where you are in the tax bracket, and then once you figure out where you are total, then you can pull out your capital gain and then subject it to that level of tax.
Perfect. I have one last thing that I want to hit on, but with respect to reverse exchanges, but I don't want to cut you off if you have any other tax piece to come out.
I think I've
exhausted your arsenal.
I could not stress enough.
So there is a reverse. There is a reverse 1031 exchange, and that is where you find the property of your dreams that you have to have, and you buy it first. Then, so you buy the replacement property before you sell the relinquished property. These are much more complex. QI fees are much higher. Time frames are completely different. They don't happen that often, so I don't want to devote like much time on this webinar or even one in the future to them because they don't happen very often at all. Fees for the QI are $5,000 and above typically, and they're messy. But in these circumstances, in this particular market, where if you want it and you got to buy it now, it is something that I at least want to throw out there to say there's an option. If that is you can look more into that. But there are lots and lots and lots and lots of opportunities there. You just have to be very familiar with the rules, and it's completely different ballgame. And they apply to so few people. I didn't want to, like I said, I didn't want to spend a bunch of time on it, but I also didn't want to overlook it because specifically the kind of market that we're in, it's something to at least, if you are in a cash position where you can buy without selling the property, then this does open up another door for you to at least explore. So that's my 2 cents on reverse.
Yep. And we've seen them happen several times. Not as often as your traditional forward exchange, but
yeah, no, I mean, in 15 years that I've done this, I've seen maybe 3. Like it's not something that I stumble into anecdotally very often at all. So just something to be mindful of. So perfect. If there aren't any other questions, I'm going to let you roll.
Yeah. Let us exchange.
Yeah, I'll exchange into a better topic next time. Thank you so much for your help, Marina, and thank you everyone for your attention. As I mentioned, if you have questions, you're welcome to email us. We'll happily point you in the right direction. We'll get you QI information. If there are other topics you'd like to hear about, we want to make sure that we're delivering content that is relevant to you, and we'd like to make sure that you're happy with it. So if you have suggestions or thoughts or feedback, you're welcome to email us and provide that as well. And we'll be back next Tuesday. See you guys.
Thank you.
Bye.